One ETF choice in 2026 could decide whether your portfolio behaves like a wealth-building machine, an income-producing workhorse, or a nervous squirrel holding a brokerage app. Growth ETFs and dividend ETFs are both powerful, but if you use the wrong one for the wrong job, you may end up chasing returns, missing income, and yelling at your screen like it personally betrayed you. If you are investing for retirement, financial freedom, or just trying to make your portfolio look less like a junk drawer with ticker symbols, this decision matters. Pick too much growth at the wrong time, and volatility can punch your confidence in the face. Pick too much dividend income too early, and you might miss years of compounding power. In 2026, the surprising winner may not be the ETF with the flashiest chart. It may be the ETF that matches your actual goal. Here is the plan. First, I will show you what growth ETFs and dividend ETFs actually do in plain English. Second, I will show you the math, the risks, and the behavior traps investors fall into. Third, I will show you a simple 2026 framework for deciding which one deserves the bigger role in your portfolio. No crystal ball, no hype, no guy in a vest screaming about alpha like he just found buried treasure. Disclaimer. This content is for educational and entertainment purposes only, and is not financial, legal, or tax advice. Investing involves risk, including loss of principal. Consider your goals, time horizon, and risk tolerance before investing. Speak with a certified financial advisor to help you develop a customized plan. Now let's get back to learning. Let's start with the basics. A growth ETF owns companies expected to grow earnings faster than the overall market. Think technology, artificial intelligence, cloud computing, semiconductors, digital infrastructure, and companies that talk about future growth with the confidence of a teenager explaining why they definitely need a new phone. A dividend ETF owns companies that pay dividends. Some focus on high current yield. Others focus on dividend growth, which means companies with a history of raising payouts over time. Charles Schwab explains that dividend ETFs may provide portfolio diversification and a regular revenue stream, but dividends are not guaranteed. Stock price declines may offset yield, and dividends can be taxable in the year they are paid. Now here is why 2026 is not a normal comparison. BlackRock's 2026 market outlook says the year may be shaped by above-trend growth, easing policy, accelerating productivity, and continued enthusiasm around AI. BlackRock also says more than $500 billion was spent on data centers in 2025, with another $5 trillion to $8 trillion in AI infrastructure spending expected through 2030. That is not pocket change. That is the economy ordering the extra-large fries. That sounds bullish for growth ETFs. But wait, Vanguard's 2026 outlook warns that while AI may help the economy, U.S. growth stocks could have muted return prospects over the next 5 to 10 years, and Vanguard sees stronger risk-return profiles in areas like high-quality U.S. fixed income, U.S. value-oriented equities, and non-U.S. developed market equities. Translation: the AI party may still be going, but Vanguard is reminding everyone to drink water and check the exit signs. Meanwhile, dividend ETFs are appealing because investors want income, quality, and something that does not require checking the NASDAQ every 17 minutes like it is a newborn baby monitor. Schwab's page for the Schwab U.S. Dividend Equity ETF shows a 0.060% expense ratio, 103 holdings, and a trailing distribution yield around 3.25% as of June 2026. That yield is not guaranteed, but for income investors, it feels more comforting than betting your entire future on whether one megacap company says AI 42 times on an earnings call. But here is where most people get this wrong. They ask, which ETF will win? Like this is a cage match and one fund is about to walk out holding a tiny championship belt. The real question is, which ETF wins for the job I need done? Growth ETFs and dividend ETFs are not enemies. They are tools. If you use the wrong tool, you end up trying to hammer a nail with a banana. Inspiring? Maybe. Effective? Absolutely not. Let's compare two simple investors. Investor A puts $100,000 into a growth ETF. Investor B puts $100,000 into a dividend ETF. We are not predicting exact returns because if someone promises you the exact market return for 2026, please check whether they are also selling miracle vitamins and beachfront property on Mars. Scenario 1. 2026 rewards AI, productivity, and earnings growth. Growth ETFs may lead because they often hold companies with faster earnings growth and heavier exposure to technology. Fidelity's 2026 mid-year outlook says soaring earnings and AI spending have helped fuel a resilient bull market, with 84% of S&P 500 companies beating first-quarter profit estimates as of May 11th, and S&P 500 operating margins reaching roughly 16%. That is strong. That is not, "I found $5 in an old jacket" strong. That is, corporate America found a second engine strong. In that environment, growth ETFs can shine. The upside is capital appreciation. If your time horizon is 10, 15, or 20 years, growth can be a powerful wealth-building engine. But growth comes with a catch. BlackRock notes that the 10 largest companies in the S&P 500 now represent more than 40% of the index market cap. That means some broad growth exposure may be more concentrated than investors realize. Your ETF might look diversified on the label, but underneath, it may be wearing the same 7 tech jerseys every day. Scenario 2. 2026 gets choppy. Energy prices jump. Inflation stays sticky. Interest rates do not cooperate. Investors rotate away from expensive growth stocks and toward quality, value, and income. In that environment, dividend ETFs may surprise people because they often hold profitable, mature companies with cash flow, discipline, and a habit of returning money to shareholders. These companies may not be as exciting as the newest AI superstar, but neither is a seatbelt, and you still want one when the road gets weird. Now let's talk total return, because this is where dividend investors sometimes get tricked. Total return equals price growth plus dividends. A dividend ETF paying 3% can still underperform a growth ETF that rises 12%. On the other hand, a growth ETF can fall hard if valuations reset, while a dividend ETF collects income and may decline less. The dividend is not a force field. It is more like a snack in your backpack. Helpful, comforting, but not enough if the bear market starts chasing you through the woods. The first big mistake is chasing past performance. Growth investors often get overconfident after a big run. They look at a chart going up and think, "I am basically Warren Buffett with better Wi-Fi." Maybe. Or maybe you bought the same mega-cap stocks everyone else bought and happen to be standing near the confetti cannon. The second big mistake is chasing yield. Dividend investors sometimes see a high yield and treat it like free money. But a high yield can mean income, or it can mean the stock price fell because the market sees trouble. That is why Schwab says investors should understand the fund's strategy, screening process, and quality screens when choosing dividend ETFs. In other words, do not buy a dividend ETF just because the yield looks thick and juicy. Sometimes the yield is steak. Sometimes it is a warning label wearing cologne. The third big mistake is ignoring taxes and account placement. Dividend ETFs can distribute taxable income each year in taxable accounts. Growth ETFs may generate more of their return through price appreciation, which can be more tax flexible if you do not sell. That does not make one automatically better. It means the right ETF may depend on whether the money is in a taxable brokerage account, IRA, Roth IRA, or retirement plan. Taxes are not exciting, but neither is changing the oil, and both can get expensive if you ignore them. The fourth big mistake is building a portfolio based on personality instead of purpose. Some investors choose growth because it feels exciting. Some choose dividends because it feels safe. But feelings are not an asset allocation model. Feelings are what make people buy at the top, sell at the bottom, and then explain it to their spouse as strategic repositioning. Vanguard's 4 investing principles are a useful antidote: goals, balance, cost, and discipline. Create clear goals. Keep a balanced and diversified mix. Minimize costs. Maintain perspective and long-term discipline. That is not flashy, but neither is flossing, and somehow the dentist keeps being right. Now here's the part nobody talks about, and it is the reason many investors lose money without realizing it. The ETF is usually not the problem. The behavior around the ETF is the problem. People buy growth after growth has already exploded. Then they buy dividends after they get scared. Then they switch back when growth starts running again. That is not a strategy. That is a financial cardio workout with terrible results and no cool gym towel. So what is the fix for 2026? Use a job-based portfolio framework. Do not ask, which ETF is better? Ask, what job do I need this money to do? If the job is long-term growth and you have a decade or more, a growth ETF can deserve a major role. If the job is income, quality, or retirement cash flow, a dividend ETF can deserve a major role. If the job is both, welcome to the club. Your portfolio may need both styles working together. Here is a simple example. An aggressive long-term investor might use growth as the larger equity sleeve, perhaps 60 to 80% of the stock allocation, with dividend ETFs as a quality and income stabilizer. A balanced investor might use a 50 and 50 or 60 and 40 mix between growth and dividends, depending on risk tolerance. An income-focused investor, or someone near retirement, might make dividend ETFs the larger sleeve, while keeping growth exposure to help fight inflation and preserve long-term purchasing power. BlackRock's 2026 outlook supports the idea of being selective and deliberate. It highlights AI as a high-conviction theme, but also says investors need diversification because market concentration is elevated. Vanguard's principles support matching investments to goals, using balance, keeping costs low, and staying disciplined. Schwab's dividend ETF guidance supports understanding the income strategy, quality screens, and risks before buying. Put that together and the message is clear. Do not marry an ETF because it had a good year. Date the data. Commit to the plan. For 2026, the surprise winner is not automatically growth. It is not automatically dividends. The winner is the investor who builds around purpose. If AI spending, productivity, and earnings growth keep leading, growth ETFs may outperform. If valuations compress, income becomes more important, or leadership broadens into value and quality, dividend ETFs may surprise people. But the strongest answer for many investors may be a blend: growth for future wealth, dividends for income and stability, and discipline so you do not blow up the plan every time a headline uses the word crisis. The takeaway, aka the recap. Growth ETFs are designed for capital appreciation. They can benefit from AI, earnings growth, productivity gains, and innovation, but they can also carry concentration risk, valuation risk, and higher volatility. Dividend ETFs are designed for income, quality, and potentially calmer behavior, but dividends are not guaranteed, yield is not protection, and taxes can matter. Total return still matters. Costs still matter. Diversification still matters. Time horizon still matters. And your behavior matters so much it probably needs its own security badge. The big lesson is this: the winner for 2026 might surprise you, because the best answer may not be choosing one style and rejecting the other. The best answer may be using both intentionally. Growth can help build the mountain. Dividends can help create the trail down the mountain. And a written plan keeps you from jumping off the mountain because one bad market headline scared you. If you find this video helpful, make sure to like, share, subscribe, and hit the notification bell to help the channel grow and reach more investors who want to build smarter, calmer portfolios. Do you want a deeper dive? Get my book, The Wealth Basics, a practical guide to investing and building generational wealth, the stuff we should have learned in high school. Available on Amazon. Link is in the description. If you want to see how this plays out in a real portfolio, watch the next video displayed on screen. It will help you continue your wealth-building journey and help you build a calm, confident system instead of a financial junk drawer with ticker symbols.